Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance. And on this episode, we're going to discuss inflation and politics, the correlation, post-election stock rotation, 2025 retirement contribution limits, and a look at the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we, good sir?
Doing well. Yeah, it's it's been a good year so far for the markets, and so hopefully we keep it up through the down the stretch here.
Yes, absolutely. Well, and that definitely correlates with the topics we're jumping into. I mean, let's dive right into inflation and politics, the correlation. We saw a heck of a jump with the stock market once we found out who was going to be the president-elect. And it's nothing new. We've seen this before.
Yeah, I mean, that was the big news last week or so was the election and the impact on the markets. And, I think there is a lot of, different views, propaganda and things. But if you kind of zoom out, I mean, what you typically see is that the stock market goes up after an election, regardless of the outcome, right? And every year, whichever party wins, they take credit and say it's a referendum on how their economic policy is so much better than the other. But the truth is, once the election's over, it reduces a source of uncertainty, right? And so, people just feel like, okay, that's one less thing to have to worry about. And as we'll talk about in a minute, market typically goes up, but not necessarily the same sectors go up, right? That maybe it changes depending on expected policy. But I think the other thing that's really interesting, is there's so much talk about, what caused, these votes to go this way, or what caused, the people to vote a certain way. But I think if you really zoom out, the interesting thing is just the correlation between the high inflation that we've experienced and most other places around the globe have experienced, and a big shift in terms of the party that was in power losing vote share.
Yeah.
Because we didn't just see that in the U.S., but we've seen that around the world in terms of big shifts, and in some cases, in opposite directions, depending on, which party or which group was in power. Voters just saying we need something different and moving in the opposite direction.
Yeah, I mean, and it's really interesting. I mean, you quote John Byrne Murdoch, chief data reporter for the Financial Times. And he noted that every governing party facing election in a developed country this year lost vote share. And that's the first time that has happened ever. We're not just talking about first time since World War II. We're talking since they've been recording this data since 1905.
Yeah, and what's interesting was this was a big year globally for elections, right? I mean, there's all different election cycles. Obviously, we vote for president every 4 years. Other countries, it's different. A lot of countries have a prime minister where, they can call elections, or, it's not necessarily as regular. But this year was just a huge number of big elections around the globe. And yet to still see that trend where in every case, the ruling party lost vote share. And really, where we've seen that it correlates around high inflation. We saw that in the 70s, and then if you go back to kind of pre Great Depression, back in those time periods where you see this big shift. And so I think that's the biggest takeaway that we can take, that following the COVID recovery, we saw prices really start to increase in 2021 and peaked at nearly 9% in 2022. I think, maybe the Federal Reserve was a little late in terms of their response, but they obviously have responded in a big way. raised interest rates, which brought inflation rates back down. Now currently the Fed has reversed course again and is lowering interest rates because I feel like they've hit those inflation targets, or at least are very close. But I think what we're seeing is once you have that level of inflation, once the cat is out of the bag, prices are not going to drop, right? Just the pace at which they increase is going to slow back to a more normal rate. And so once you've had that high inflation, you'll really never be able to make up for it. Once that cat is out of the bag, it just becomes an economic reality. And clearly one that, the average citizen, the average voter, not just in the US, but globally, is not happy about.
Yeah, and I thank you for pointing that out too. That sometimes I think when we discuss these things, or maybe when we're thinking about how we've had to just pay the amount of increases from home cost to groceries, gas, energy, so on and so forth. That this wasn't just here in the U.S. This has been a thing that has affected global economies all over the world.
Yeah, and I think as often is the case with politics, and I try to remind people constantly is the president or the party, if they also control Congress, right? That's the ruling party, if you will. They only have so much ability to influence these big macroeconomic factors. The way I look at it is, there's these major trends that's really driven by all of us, right? The American people, or people globally, and how they choose to spend their time, money, and energy. And that's going to determine the general trend of what's happening in the economy. And Washington or other capitals around the world, their policies may be able to kind of tap the brakes a little bit on that, or maybe tap the accelerator a little bit, and that obviously has impact on a lot of things such as economic growth, unemployment, and inflation. But there really is a limited amount that they can do to really influence it.
Yeah, yeah, and it's pretty interesting. I mean, there's some different stuff that's highlighted in the personal financial review, talking everything from Brazil, what they've been facing, especially rising cost of fuels, electricity, in England, what has happened there as far as their highest inflation in decades. And some governments have policies to act a little bit more quickly to change leadership. But sometimes that doesn't always yield the maybe the intended or desired outcome either.
Yeah, I think it's more just a way for people to voice their frustration, right? Rather than seeing direct impact. And we've seen that in the U.S., right? When you had Gerald Ford declared inflation public enemy number one, right? And served for a short time period. You had Jimmy Carter declared it the nation's most pressing problem. We've seen our own politics oscillate back and forth between different parties, and yet, all facing the same challenge of how did they bring down inflation until, eventually the right pieces are in place to be able to impact it. And a lot of times that it's more of a monetary effect as it relates to, the central bank and, what they're willing or able to do to bring down inflation, which has offsetting challenges because being really focused on inflation can lead to higher unemployment and other things that are also, very challenging. But at least at this point, we seem to have, got over that hump, and we're in a better situation going forward in terms of those big picture issues of the economy growing, unemployment being very low, inflation is down and seemingly still trending downward, and arguably the biggest impact that goes beyond political ramifications and things is the Federal Reserve lowering interest rates, and I would argue that's even a bigger factor than other things we've been talking about, such as tax policy and trade policy. Interest rate policy really is the 800-pound gorilla.
Yeah, well, and I think it's a great that you mentioned here too. Of course, what we were faced late '70s and pretty much all throughout the '80s, and the amount of the rate at which they had to raise interest. And, we're not that we're in the most of ideal times and situations with it, but we are in a better place than history would show. And there are some trends showing that things will continue to evolve in a positive direction.
That's the way it looks now. And ideally, yeah, we're returning to kind of more of a period of normalcy following the pandemic, the high inflation, a lot of the challenges that we faced, that we finally returned to kind of that right balance.
Yeah. Yep. Anything else you want to add here before we move to our next topic?
Well, just that I think a lot of times it's good to kind of zoom out, especially as things get really, bipartisan and looking at numbers from one side or the other. I mean, as I often say, the one thing that just about every U.S. president has in common is that the economy has grown and the market has gone up during their tenure, right? And you can argue, maybe a little more because of this policy or a little less because of this policy. But if you zoom out and you look at, the long-term big picture, it's generally positive.
Yeah. All right. Post-election stock rotation. The U.S. stock market in general increased in value following the U.S. presidential election, and you touched on that a bit. It's not a surprise. It's pretty typical. However, it wasn't all sectors, and I think sometimes the headlines can be very misleading about that. I'll just say, stock market rebounds, jump 600 points, 800 points, whatever it is, without taking a look at all facets of what sectors actually did have an improvement.
Right. Yeah. You can see the headline, S&P 500, surges this much, right? But, there may be some other nuances there that are being missed. One of the ones that really jumped out for me was following the election, we saw U.S. stocks really move up, but non-U.S. stocks actually went down.
Mm.
And that was, I think, two factors. I mean, one, we saw a pretty significant increase in the U.S. dollar. The U.S. dollar is up 3% since the election, which is a pretty big move. And what that does is it makes foreign investments less valuable when they're denominated in dollars. And clearly, this trend, I think, is just pricing in the increased, risk of tariffs or trade war or that type of thing. And really assuming that the U.S. is in a stronger position if we were to go into a trade war or have tariffs going back and forth, and therefore the increase in the value of the dollar.
Yeah. Well, what's at the core of the strong performance? I mean, I know that there was talk about smaller regional banks having a rebound. Are we seeing that across the board with financial institutions?
Yeah, the other interesting thing was small and mid-sized companies had posted really strong returns. So usually we focus on the large company indices, and that's what everyone was talking about. Is you drill down and you look at smaller companies, saw really strong performance, and one of the big leaders was smaller regional banks. A lot of them were up more than 10% the day after the election alone, and in some cases have added to those gains. And I think that's due to expectations that the really strict regulations that have hampered small banks for decades may be relaxed. Really, there's only been one new bank chartered in the U.S. since the Dodd-Frank Financial Regulatory Act in 2010. And the reason is it's just really difficult for a small bank to, start from scratch because of the really high regulatory costs. And if anything, what we've seen is a lot of mergers in that area where there's fewer and fewer small banks because they need to merge to gain scale to be able to cover those costs. So that could be good for that sector. And, arguably it could be a positive thing for a lot of small towns and things. It's typically those community lenders, as they call them, right? Smaller banks where they collect deposits in their community and lend within their community. And there's certain areas like commercial real estate that, typically it's very dependent on those local lenders, local relationships to build the infrastructure that smaller communities may need.
Yeah, absolutely. Well, and is that a sign maybe in just the small and mid-sized stocks in general is that It's that optimism around the prosperity where a lot of small businesses and mid-sized businesses were really hurting that again, along with these regulatory changes that will not only help the smaller banks, but thus maybe the lending so that these smaller mid-sized companies can reinvest in potential growth.
Yeah, possibly. I mean, it could also be looking at interest rates coming down, right? So more demand for loans. The other thing, because we also saw large banks do well, not as well
Hmm.
as the smaller regional banks, which really fueled more value stocks over growth stocks, which was another kind of shift in the trend. And that might partly be due to reduced tax risk. If you look at banks, I mean, most banks are, chartered at the, either the federal or the state level. These are not necessarily multinational companies
Hmm.
where they have the ability to, move money around between different tax jurisdictions and play those games. I mean, typically they're kind of more cut and dry. Their operations are here in the U.S. They're going to be subject to U.S. tax policy. So an increase in the corporate tax rate would be more likely to affect, financial companies, would be more likely to affect small and mid-sized companies that may just have, a regional footprint and definitely not a global footprint given their small size. So the reduced risk of an increase in the corporate tax rate may also be something that's being priced into the market there.
All right. Anything else you want to add before we jump to 2025 retirement contribution limits?
Well, just that, these things are things that we're going to need to continue to track and continue to, look at policies as they're presented and factor in how it may affect certain segments of the stock market. So even though, you may see the big picture, that the stock market's trending up or down, really kind of looking under the hood and seeing those individual pieces is just as important.
All right. Well, let's take a look at 2025 retirement contribution limits. The contribution limits for the 401k type plans, they're going to increase. So, what increases are we seeing there?
Yeah, this was probably our continued theme of inflation adjustments in the tax code, right? We touched on it last podcast, and now there's been more coming out. Yeah, the 401k type plans, right? So that includes like 401ks, 403bs, 457s, all of those kind of similar retirement plans. They'll see an increase in the maximum contribution from 23,000 to 23,500.
Hmm.
The reason that is when inflation is high enough to warrant a full $500 increase to the limit, then that's when it kicks in. It goes in $500 increments. So it doesn't go up every year, but if inflation compounds enough, it will increase. And that's also partly why the age 50 plus catch up contributions, right? So people that are age 50 and over can put in an additional amount, but that's remaining unchanged at 7,500 because the percentage increase on 7,500 just wasn't enough to, increase by a full $500 increment. Whereas the percentage increase on 23,000 obviously doesn't have to be as high to equal $500. So yeah, what we'll see is that overall people will be able to contribute about $500 more into their 401k, 457, 403b type plans.
What about traditional IRA and Roth IRA contributions? We looking about the same? Any changes there to the contribution limit and the age 50 plus catch up?
Yeah, so with the smaller contribution limits for IRAs and Roth IRAs, inflation was just not high enough to warrant a $500 increase. So those will stay the same at 7,000 plus an additional $1,000 for those age 50 and up. But we did see an increase in the SEP IRA and solo 401k limits because it's such a large amount. So that increased a bit to 70,000. Again, you have to have sufficient income, and there's a lot of pros and cons to necessarily maybe wanting to contribute that full amount. But for those with really high income and maybe one person businesses and things where they don't have to worry about contributing for employees, which could get really costly, they have some pretty high limits going forward.
And what are we looking at as far as income ranges for determining eligibility to make deductible contributions?
Yeah, so those also increase slightly, right? There's limits as to how much income you can have and make a deductible contribution to a traditional IRA. There's limits to how high your income can be and still be eligible to contribute to a Roth. So those went up a bit. Those went up a bit for most taxpayers, based on inflation. The one holdout would be those that are married filing separately.
Mm.
That still remains really low. It's one of the penalties for for taking on that type of that tax filing status.
And let's take a look at the starting in 2025, the maximum 401k catch-up contribution for participants who attain ages 60, 63 during the calendar year. We've talked about this, but I do believe it's been almost a calendar year since we've touched on this in particular.
I think so, at least. Yeah, this was the Secure Act 2.0, and it was a really odd provision, and it's still going to be interesting to see exactly how it plays out. But it's finally, being implemented after, those passed in law but delayed and not coming into effect until 2025. But it's kind of this strange scenario where 401k or 403b, 401, 457 type plan participants who are ages 60 to 63 during the calendar year, their catch-up provision, so the amount that's normally allowed for people over age 50 will actually be 150% of the normal catch-up. So we talked about the normal catch-up remained unchanged at $7,500. Well, for those that are between age 60 and 63, they will have a catch up of $11,250. So it's kind of a little bit of a larger catch up just for that short time period, when they're between those ages in order to maybe be able to get just a little bit more into their retirement plans.
Yeah, that's definitely interesting, but I'm guessing that's probably because that is closer to that retirement age. And is it also connected to when mandatory withdrawals start to happen?
Now, mandatory withdrawals don't start to kick in until 73, so you've got
Okay,
a
thank
while.
you.
But yeah, I think it's people getting closer to retirement, and so they can kind of super fund or fund a little more for that short time period to maybe catch up to be on track. Um, so that'll be interesting to see how that plays out and how it's managed. The other thing that's going to be interesting is there's another provision that's coming into effect where high income participants will be required to defer their catch-up contributions into Roth accounts.
Hmm.
So these will now be after-tax savings instead of pre-tax savings. I'm guessing that's was some way to generate some additional tax revenue to pay for some of the other provisions. So another thing that will maybe require some planning, as a lot of people might still be maxing out and maybe even able to put in more than they, in some cases, quite a bit more than they have in the past, but having to do so on an after-tax basis so that their tax liability is actually going up.
Yeah, yeah. Anything else you want to add before we jump to the bulletin board?
Well, if this hasn't been confusing enough, with everything starting in 2025, I think anyone who's in that situation where their catch-up contributions are being deferred to the Roth, or if they're between age 60 and 63 and they have additional options in terms of the catch-up, definitely worth talking to your financial planner and making sure you understand what those implications may be.
Yes, absolutely. All right, we're taking a look at the Plan Solutions Incorporated Office Bulletin Board. We've got one item pinned up there. What is it, Mr. Armour?
Yeah, so just want to give people a reminder, that there was some changes in the tax code, fairly recently, but also some that go back to the 2017 Tax Act, where, in essence, related to charitable giving. And this is a time of year where we get a lot of questions about that. So ever since the 2017 Tax Act, the amount of the standard deduction increased quite a bit. And we saw a big reduction in the number of people that are itemizing their deductions. And for a lot of, especially, retirees where maybe their house is paid off or their mortgage, is really low, charitable giving can be one of their larger deductions.
Mhm.
And they may be missing out on the benefit because the standard deduction is higher. And so therefore their itemized deductions are just not exceeding that, even with their charitable contributions. So there's a couple options that are worth looking at. One is the qualified charitable distribution, where someone can contribute directly from their IRA to a charity, and it doesn't even show up as taxable income. Now, this only applies to people that are age 70 and a half or older. So, it doesn't work for everyone, but if you're in that situation, it may be something to consider, even though you're not required to start taking from those retirement accounts until age 73. You can take advantage of this provision. Another one that we've looked at is the ability to make lump sum charitable contributions into a donor advised fund. So this is where maybe you look at the giving that you're planning on doing over the next 5 to 10 years and making a lump sum contribution, so you get that tax deduction all up front. And then the money inside the donor advised fund can actually be invested, so potentially, still increase in value over time, but can be doled out in future years. And then there's some other things like the use of charitable trusts or, donation of appreciated investments to avoid paying taxes on the gains. So a number of different ways that, maybe don't apply to everybody, but in a lot of cases it can, it can make someone's charitable giving more tax efficient.
Yeah, and when we talk about this being more tax efficient, we are talking federal taxes, correct? Not state, because it varies state to state. Am I correct in
That's
that?
right. Yes. And that's also something worth looking at. I mean, a lot of states did not conform to the 2017 Tax Act. So, potentially there are still a lot more people getting state tax benefits for those charitable contributions. But, restructuring it, you may be able to benefit on both. And typically, the federal tax rates are quite a bit higher than the state tax rate. So that's usually what drives a lot of that decision making.
Yes, sir. All right. Anything you want to add, Mr. Armour, as we wrap up this edition of the Plan Solutions Incorporated podcast?
Just hope everyone has a great Thanksgiving. I don't think our next podcast will come out until after Thanksgiving. So I know that's my favorite holiday. Good food, family, and football. Although it looks like the way the football season's shaking up, we're not going to have many very good games. Not to not to offend anyone who might be a Cowboys or a Giants fan, but either way, it'll still be good.
Yeah. Well, hey, it's about the tradition, not so much the outcome of that, right?
That's right.
Well, we thank you all for listening to the podcast on Apple Podcasts, Spotify, and of course, we are also on YouTube. Yes, Plan Solutions has a YouTube channel where you can go to youtube.com/Plan Solutions, and you'll find the podcast there. If you'd like to follow along with the video, which will have the personal financial review in an animated form, or simply, subscribe to the personal financial review if you haven't yet. All you need to do is email Katie, that's Katie, @plansolutions.com, and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.